started. I am so excited today that we've got Brad Pittman with us. He is an R&D tax credit expert from Smith & Howard out of Atlanta, Georgia. Brad, do you want to just do a quick intro and then I'll kind of kick us back over into what we're going to be talking about today?
Yeah, thank you, Elizabeth. Happy to be here and happy to do that. So as Elizabeth indicated, I'm with Smith Howard. We're an Atlanta-based CPA firm, but we've recently established a presence in Birmingham through the acquisition of Horton Lee. And we're excited about that. We're excited to grow into that market. We've been looking to move west from Atlanta. Part of our growth strategy is to really connect our offices between Texas and Atlanta, and also bring in a new set of clients that we can help with our specialties, but bring the resources we have to Horton Lee and allow them to tap into markets that maybe historically they weren't able to reach. So it's been a good partnership. We hosted a similar session in person about 6 weeks ago at the Innovation Center in Birmingham, and I thought that went really well. So we're excited to talk about it again today. It's a passion subject for me. It's the core of our business, and specialty tax services is the helping of clients claim these credits and create documentation that'll survive scrutiny from the IRS and other tax authorities as they potentially get examined in the future.
Awesome. Okay, well, thank you so much, Brad. I'm really excited about R&D tax credits, which I know that usually people do not say that they are super excited about tax things, but I really am. So LunarLab, my company, as you may or may not know, we are a UX design and product strategy company. We're based out of Birmingham, Alabama. I'm our CEO, Elizabeth Anderson. And we are very passionate about helping small businesses and startup founders to be able to execute successfully, whether we're doing that through design, product strategy services, user research, project management, just about any kind of help that we can do, just business consulting in general. But we want to help startups and small businesses be successful. And one of the things that we have been doing over the past few years is we've been in Washington many times to talk about the R&D tax deduction and tax credit. So Brad's going to tell us a little bit more about why we needed to go up there, but just at a high level, the R&D tax credit went away for many years. It's back now, partially because so many small businesses and startup founders, we really need it, right? We need it to be able to get these tax credits to do this innovative work, but it was gone for a little while. And so my company went up to Washington with a really great group called the App Association, and we basically talked to federal agencies, to Senate offices, to House offices, and said, hey, we need this. This is really important. This allows our companies here in the United States to be more competitive on a global scale, but it also just helps with lots of different things within your company, whether that's, you're saving up so that you can hire more staff members, or you're building out really interesting and exciting new technology. These tax credits can help you to build your business, and we're so excited about it. Now, my company cannot actually take advantage of this, sadly. So we can't do it, but you can. And we want you to be able to, because all of our services are R&D. So that is why we are so excited about it. And I have been talking about it for years and years, and I'm thrilled that it's back. So with that said, I'm going to let Brad get into it a little bit. He's got a really great presentation for us today. And if you have questions along the way, feel free to pop those in the chat. We'll kind of get to more questions at the end of this presentation, but pop them in as you have them. Please, we welcome your questions, and we really want this to be interactive for you. All right, so take it away, Brad.
Thank you, Elizabeth. We'll touch on a few points you mentioned. It will expand on that a little further in terms of the renewed opportunity that's back for 2025 and moving forward, some of the ability to recapture some of the negative impact that the change in tax law actually several years ago had on the credit for the 2022 through 24 years. But before we get into some of the mechanics of monetizing the credit, I think it'd be good to talk around how you go about getting to the point of claiming a credit. So what are the foundational principles that drive creditability in the R&D space? Let's start with the basics. So research and development. I think even that, when you hear research and development and you're not exposed to what actually qualifies for credit, and it's all about activity. So when I before I got involved in this space, probably 10 or 11 years ago, I would have thought of scientists in lab coats. I would have thought of beakers, at the very, kind of scientific experimentation type of activity. Absolutely, that's going to qualify for credit. But the definition, as the IRS has laid it out over the years, both in the Internal Revenue Code and its regulations, as well as in case law and the way that they've kind of opined on what the definition is and expanded it and sometimes contracted it, is it's much broader. It's a much wider net that's cast than just that kind of stereotypical development and experimentation activity I talked about. It's around products and it's around processes. Think about anything you're doing to bring a new product or service to the market. When I think about it's not just tangible products also. So if you're in Elizabeth's world as a kind of a contract development support partner to her clients, the things that they're doing to iterate around the UI UX experience and other parts of software development, those are absolutely in the world of qualifying, even though it's not a tangible product that you can hold. So we certainly help a lot of manufacturing companies who are coming up with new products or improving on existing products. Because again, it's not just new products to the market, and even if a product exists in the market, if it's new to your business, then it still counts. So there's really a much wider opportunity than I think some people understand. And then on the process side, some of that it kind of blends together in the tech space. It's more kind of siloed in the manufacturing space, although even there can be some crossover. But especially when you think about anything software development, it's not just what you're making, but the process you go about to develop the solution that can qualify for credit. So you have a blurring of the line in the software development technology space, but sometimes people think about, okay, this year I didn't really take a new alpha or beta software solution to the market, but if you're sitting in the background, improving the way that you go about your development lifecycle, even that can be an opportunity for a credit claim. And again, it's all about activity. So what we talk about a credit claim, what is it? It's a dollar for dollar credit against your tax liability. So it's unlike a deduction that is an expense you're incurring to reach taxable income. And many of these deductions, in fact, all of these deductions are part of what qualifies for a credit, with a credit being some percentage of the deductions that you are incurring, the spend you're incurring to innovate, to develop. People pay. We'll talk a little bit more about what the different buckets of expense are that qualify for credit. But first, it's about its qualifying activity and then tying expense to that activity. So if we think about what are the core concepts, we call it QRA and QRD in our industry, but the expanded terminology is qualifying research activity. So there's a 4-part test that we'll walk through shortly that defines what a qualifying research activity is, and then once you've defined the activity, which is the bulk of our work in any project when we help clients go about the process of making these claims, is defining activity and being open-minded and thinking outside the box. We want to be in a defendable position, but we don't want to sell ourselves short. So the more activity we can qualify for, the more people, the bigger the bucket of expense that you tie to that. And then the bigger credit claim that you can make on your tax returns. So we qualify activity, then we tie the spend. And what is the spend? W-2 pay to employees, contract development expense. Again, think LunarLabs for that. Materials and supplies consumed in development, probably in more of a traditional manufacturing environment. If you're building a prototype, if you're running materials through a pilot run on a new production solution, so that consumption can qualify. And then there's also cloud computing in the tech space that we see regularly. So if you're using AWS or Microsoft Azure or some other type of cloud solution to host your development environment, even the cost you're incurring there, or at least some piece of it, might be able to qualify for credit. So again, people pay, materials and supplies, contract development, and then again in tech-based cloud computing costs. And I think we'll dig more into that and kind of some of the detailed and nuanced elements of the expense in a few slides. But back to the 4-part test for activity. So must be for what we call a permitted purpose. Now, a permitted purpose, the simple way to think about that is and we use this terminology business component, but I think about it as a product, process, technique, formula, or software that you are either creating brand new or significantly improving on. And those are the kind of categories of development that can qualify for credit. That test is usually pretty easy to pass. If you're doing something innovative, if you're making something better, whether it's an efficiency gain on an existing process or just a new product or existing product improvement, I don't find that we have a lot of trouble qualifying clients for that test. Second test, it must be technological in nature. So it must employ some field of hard science. That could be physics or chemistry. That could be the biological sciences. When you think about technology driven companies, software development companies, it's computer science often. That's the check in the box there. Various fields of engineering, mechanical, electrical, physical, all the fields of engineering can qualify. This is also a test that's pretty easy to check the box on. Typically, is when we get to the next slide here, where we start talking about the elimination of technical uncertainty and substantially all of the activity related to must exhibit a process of experimentation. This is where we add value, and maybe it's happening, but it's not formally documented. I think it's fairly straightforward in a software development or related space activity where there's a lot of tracking that's happening. You're looking at different versions of the software, different versions of whatever the solution is that's in the technology space that you're tracking as a business for your own purposes. Usually pretty easy to show that path, and then also at the front end of it, some of the questions you were asking yourself in development. That's when I look back on an initiative that maybe wasn't a formal project, or even if it was, it may not be laying out as in some type of memo as, okay, these are the technical uncertainties we want to eliminate. But you're saying that another way by saying, okay, where are we? Where do we want to go? What are the developmental questions we're asking? We think about how we add value to clients, especially in the manufacturing space, where maybe there aren't those huddles before you jump into some type of a 1 or 2 week scrum to push a software development forward. We help them kind of think back and define those questions, because there's often a lot more technical uncertainty than they realize. They're just going about their jobs and developing products, developing processes. But that's where we add value, because that's where the IRS is going to be place more scrutiny, is around these two tests. And then they really interrelate, because if you don't have, it's not that every project needs to have a long path of experimentation to qualify. That often is a correlation there. So the higher the uncertainty, the more POE or process of experimentation is happening. But sometimes you might consider a couple of alternatives and hit it right with the path of development. And so it's a shorter loop, but that doesn't mean there weren't still a significant number of questions you were asking yourself on the front end that check that box for technical uncertainty. So again, these third and fourth prongs of the test, they very much are tied together. You think of some examples of process of experimentation can be modeling or simulation. That can be iterative trial and development, both in like a computer aided design world, or in when we think about prototyping, building a prototype, testing it, whether that's a digital prototype or a physical prototype, and then going back to the drawing board and refining the design of that physical or digital product based on what the test results are giving you. Formulation and formal development of scientific hypotheses, we probably see that more in the chemical and pharma industries, but I mean that's not exclusive to those industries. And then of course, just the natural iterative development of code that's often a foundational piece of software development that's going to qualify as a process of experimentation. So we've gotten through the 4-part test. And we're again doing this on a business component basis. And when we think about how we help clients make these claims, there's some reporting that's required now. So it's important when we go through a project, and for you to be thinking about, if you're considering an R&D credit, track your projects in those buckets. So each project will be a business component, and that's probably already happening, but it's important to, even to the extent you can, track and assign costs to the different projects, because at some point when it goes into the tax return, and if you're spending enough money, the claim has to have certain granularity to it in terms of the different business components to which people's activity was tied, to which the spend was tied. So the more that you're kind of tracking it and thinking about it that way on a project by project basis, rather than just, well, my 5 employees doing software development, they were highly iterative in their activity throughout the year. maybe they're working on 5 projects, maybe they're working on 50 projects. So you need to be able to track that activity against those projects, because if you're spending enough money, I think it's about $1.5 million to spend. So significant, but if you're in that world, the development spend has to be reported into the tax return with a lot more detail than if it's a smaller claim.
So, Brad, I have a question about that. When we're doing the tracking, for those of us who are in the more technical side of things, we're very used to doing things like time tracking for our projects. And we're very used to writing user stories for all of the work that we're doing. And we're tracking outcomes typically. Do those things count towards the tracking?
Absolutely. Time tracking, in an ideal world, time tracking is important, but you want to have something. It's a great kind of starting point for creating a nexus between people and activity, but the IRS wants to see as much as they can on top of that. So meeting minutes from huddles with the team, emails back and forth. Maybe there's a Teams chat. Anything that you can, because if you just enter time and you just track time, but there's nothing else in the file that really links the people to the project, the issue you can run into is that the IRS walks in the door. Not that they presume that people are misrepresenting the time commitment that is spent, but if it's just time entry, looking at a timesheet versus looking at some estimated percentage of someone's time, that feels the same to the IRS without, again, other supporting documents to really link people to projects. So time tracking is important, and I think it's preferred over kind of putting your thumb in the air and saying, okay, they were 50% developmental this year. It usually will give you a better starting point to assessing what the fair percentage is, but it's that kind of broader file of documentation. It's probably there, maybe in some cases with more formality than others, that ties in with the time tracking that will really bolster your claim against scrutiny. Again, the scrutiny is increasing in recent years because what would happen is people would just put numbers onto a form, make a claim, and knowing they were willing to play the audit lottery. So the IRS is, and continues to be, I mean, especially right now with the government shutdown, limited resources there, so they can only attack so many cases. So I think a lot of people would play the audit lottery. So the IRS's response was, we're going to make you put more information into this claim, and even if you're not putting in the claim, we're going to expect when we come visit you, if we do, that you've got a good file to really substantiate the numbers that you're putting onto this form. And so, again, back to your question, Elizabeth, time tracking is a really good starting point. Have other files, other links that create the nexus between people and project. I don't know if that answers your question.
It does. So we're going to write everything down, and we're going to take super good notes, and we're going to track all of our time, and we're going to tie that back to our KPIs. But you just said IRS, and IRS is scary. We love the IRS and all the things that they do. We love our IRS agents, but we would love to not see them. We would love them from afar. Okay.
It's a good point. They're a necessary service. We need revenue as a society. That the IRS needs revenue to drive government programs that are beneficial to everybody, right? But
yes.
we never want to avoid tax. We never use that word. We don't want to evade. We want to minimize our tax burden with programs that, of course, and we'll talk a little bit in a few minutes about the startup piece of this. Mm-hmm. The startup credit opportunity is exactly what you said, Elizabeth, to spur companies that are cash strapped to be able to continue to develop solutions that will be beneficial to society as a whole. And so the IRS has granted a special opportunity. We have a slide on it that I'll get into, to help companies in that first 5 years of operation, maybe pre-revenue, just a little bit of revenue, have a more immediate path to monetizing the claim. And I think that's important. I mean, they certainly want to collect tax revenue to fund the government, but they also know that by spurring innovation, it ultimately will put more revenue in their coffers, because we're keeping innovation here. We're having businesses become successful. And, there's something, I think, patriotic about paying tax, but we don't want to pay too much tax, right? We want to pay what's a fair share. On this AI slide, back to your question about note taking, we certainly use it in our process. We've implemented Fireflies into Teams. I know there's so many different AI-driven solutions as transcribers, but that can be a great way in your development meetings to just invite one of those transcribing tools, those AI-driven tools, to the meeting that can create that documentation for you where nobody's really even having to take physical notes anymore. We've certainly used that in all of our subject matter expert interviews over the last year, and it's been very helpful and good documentation on our side.
And Brad, just a quick follow-up question on that, because the IRS is scary and we want to love them from afar. But that said, when we are collecting all this documentation, we're going to collect it and then we're going to send it to our accountant, right? We're not going to try to be filing this stuff ourselves, and our accountant's going to make our lives very, very easy. Is that correct? So that
not just easy, but making sure there's no stone unturned. Because again, I think even me being in the public accounting space for 20 years, but probably a little over half of that in the R&D space specifically, I came into it, but when I first started to learn about the topic and since become much more well-versed, good or bad. I think it's a necessary evil to be good at what you do, but it's a thing where we add value in a defendable answer, but we also add value in an optimized answer. And trying to do it yourself in not having that context of case law, of having so many of these fact patterns come across our desks over the years, you might be missing out on dollars that can help drive your business forward. So it's a good point, Elizabeth. We're here, we as your whether it's Smith Howard or whoever is your accountant, we have the specialty capability in the R&D space, whether or not we prepare your tax returns, to really work closely with your tax accountant and maximize the value for you here in this space.
Yeah, and the people that I have talked to who have gone through this process, because there are quite a few, are really saving huge amounts of money. Like I'm not kidding when I say it saves a lot of money. We're talking like $75,000, $100,000. Now it's not that much for everybody, but it certainly happens that way. And the accounting services do not cost that much to get to the savings, right?
Absolutely. The ROI almost always makes sense. Now, if you really start up and there's just a kind of a smaller amount of spend, we understand that, again, from our side, there's a minimum amount of work to do a good job. So, but it quickly, you hurdle that where the ROI starts to become meaningful to go through this exercise. And some people are worried, okay, is it creating exposure by making this claim? You shouldn't worry about that if you have a good provider, because they're going to prepare a reasonable and defensible, but also tax optimized claim that will save you money and pass scrutiny. Touching briefly on AI, I think you could kind of read what's on the slide, but this is certainly, again, an area where AI related technology can drive forward and can be a form of qualifying research activity. I think it's important that it can't be an existing tool. So when you look at, there's already an AI solution out there and you're kind of incorporating it into a broader process, it's kind of a gray area, but there are paths where if you're using AI and it's not like a large piece of what you're doing on a broader basis, but it is kind of I look at it in a process improvement type of world. So you have a development process, but there's ways you can plug AI in at certain points in that process to make those steps more efficient. But again, that's still a technology. It might exist, but you're using it in your own novel development process where you can push some of your AI initiatives into the world of qualifying research activity. It's still, there's no real case law since it's so new. So I can't say with a high degree of confidence that how the IRS would view that. But I think if you look at these yeses and nos, these are when we try to be conservative when we're looking at this. So some of these nos may look like to some of the audience maybe a maybe. And we, even in our last discussion, we kind of maybe concluded on some of them being maybes, but I'd rather put it more in the no category to be safe. And then we get in a case by case kind of analysis. Maybe it becomes a maybe or a yes instead of a no. But let me advance here. So we've qualified activity. Now we tie spend. We talked about at the high level wages, contract development, materials and supplies. Those are really the big three prongs. And I'd say wages are usually the biggest piece, but it depends on your organization. If you think about you don't have the head count, so you're going to farm out somebody outside of the organization that really, or maybe they're just a specialist team that can really drive a certain part of the overall development plan forward. that's getting to the next slide, and we'll talk a little bit more about that. It's not always wages that's the biggest spend. It can be contract development. But in the world of wages, you have people that might be direct involved, people that are supervising, people that are supporting. Your direct involves oftentimes get into this world on that last bullet of being what's called a substantially all employee for R&D. In that world, if you qualify more than 80% of a person's time, in other words, they're working on projects that fit the mold of qualifying research activity on, let's say, 4 or more out of 5 days of the week, and the IRS lets you take 100% of their wages. So that's a nice bonus when you have maybe a core team, that's all they do. And that's regularly the case for us. We have a lot of people that fit into the supervisory and supporting world as well, but your biggest chunk of your spend is normally the people driving development forward day to day that get into the substantially all world. Contract development, we were just talking about that. So there is a little bit of a haircut here when it's not a W-2 employee, but LunarLabs is a classic example of contract development. So as Elizabeth was mentioning, they can't claim the credit themselves, but they can. This money you spend with them can be put into this contract development bucket. And that again, if it either because of capacity or not competence but capability, you might need to outsource a certain parts of the project to an outfit like LunarLabs, and it's something you need to remember that you don't want to miss out on that bucket of spend. And it's not only the people that work for you, but the people that are partnering with you in terms of third-party firms, and they have to be U.S. based, which LunarLabs is. So it can't be a foreign resource there. If it's clear to you that you're contracting with a firm outside the U.S., it would be very aggressive to qualify that spend for credit. It's generally going to be a no for a credit to claim to qualify that type of spend. You can see some of the examples of how you might spend that money on an outsourced resource. And we see a lot of it with product testing. We see a lot of it with the UX UI design and things that, maybe you have software coders, but that's kind of one piece of software development, but there's a certain part of it that is better left to the professional that is not kind of their core expertise. Elizabeth, I don't know if you have anything to add here, just from your lens as the leader of LunarLab.
Yeah, that UX design piece, even though it feels separate, it is kind of part of the software development process, and that's part of why it qualifies. When we get into that validation testing, prototype development, all of these things, those are research, right? Those are all different ways that you're doing research. So now you all know why we love the R&D tax credit so much, because you can use it to pay for our services. But while we're here on this topic of qualifying research expenses, we have a message from the chat. Are joint research expenses with universities like research hospitals eligible? So medical and cancer research focus. That's a
good question. And I think I'm going to jump ahead to answer it, and I don't think we'll miss too much. Materials and supplies, just very quickly, are tied to more of a traditional product development world when you think about consuming material in a prototype or in like the testing of a new process. But there's a slide, and I'll come back to internal use, but I want to address this because this is tied to funded research potentially. So joint expenses with universities, sometimes what you'll see is you get a grant, a government grant or university grant to fund your research. So if it's joint and you are at your own expense, then it could potentially still qualify. But this funded research test is kind of above and beyond. So you may qualify all day long under the 4-part activity test, but how is the research fitting into the world of being funded or not funded? So we call it the rights and risk test. So risk would be, are you getting a grant or other type of funding that's covering your research? That would kind of put you in a world of funded research, and you'd fill the eligibility for credit. Or maybe you're bearing your own cost, but there's something in the contract of this joint partnership where the IP that is created through the joint venture is not, you don't have a substantial right in that research and that IP, then you would fail the funded research test under that prong of the test. So you really need to have both a substantial right in whatever's created in terms of intellectual property, and you need to be bearing the risk in terms of not being funded financially. Now, we have clients where it's part funded, and so this might be what this joint question would be. As long as you're retaining a substantial right in the research, you would qualify activity first and then understand the funding sources. So if you're paying people $1 million, but 500,000 of that is specifically offset with some type of a grant, then you would in theory reduce the qualifying expense by that grant amount or that funded amount. Also, sometimes this funding is not specifically tied to research and development. It's really a broader funding of the organization. So it's definitely facts and circumstances based, looking at contracts for who owns the rights, and then also understanding what is the funding and the joint research. If there is some funding involved, what is it really driving? Is it the entity as a whole, or is it specific to R&D? So the answer is a little bit of it depends, but those are the things to be thinking about when you're talking about joint expenses with universities. I hope that answers the question.
Thank you.
Let me go back a little bit. So internal use software, we've been talking about software development at several points today. So the concept of internal use software is qualifying. If you're producing a software solution that's going out to the market, that's your deliverable to your customer, either on a selling it one-time basis or perpetual license or annual license, whatever that might be. That's one category of software development that's more easily qualified. If it's internal use, so you are pushing a process forward with a better solution for in one of your software. You look at these examples, financial management programs. I think an ERP is one that often will not qualify because there's usually an ERP that exists, an enterprise resource planning tool that you're buying and then customizing. The IRS doesn't love that, and we'll see why. But if it's, again, innovative in terms of the reduction of costs, improving the speed, or other types of innovation that makes you more efficient, that's going to check the box of one of the 3 tests of what we call a higher threshold of innovation tests that are specific to internal use software. You also have to bear risk. Normally, the money you're spending for some type of software development initiative that's in-house checks that box easily. It's this last test around not being commercially available or not, so-called off-the-shelf software. Because my classic example that I always use, we had a client that went through, and we didn't do the work, but they ended up getting a claim denied because they took their spend on an SAP implementation as an example of a internal use software initiative. The problem was, and in the IRS's view, SAP is an off-the-shelf solution. Even if you're customizing it to your organization, there is too much of a foundational software that already exists, and there's not enough, in the IRS's eyes, iterative development beyond that solution that already is licensed out to the market. So that would be a case where SAP at some point in developing that solution might have had a credit claim, but you as a user of SAP and as an implementer of SAP, that's not going to check this off the shelf or not off the shelf box. Now, sometimes you'll see clients that, we had a client that developed a warehouse management system, software, internal use software, not customer facing, but they contracted with a software developer and built this from scratch, from the ground up, blank canvas development. That could qualify. It made their business better, but there was nothing foundational. They spent a lot of money on it, so it ended up being pretty beneficial for them for credit. But again, for internal use software, I think this is the test that most commonly fails, is there needs to be no kind of foundational software that's more of a customization implementation exercise. It needs to be blank canvas development. We talked about funded research. This is something that's going away. We alluded to this at the front end of the discussion, but there's some remedies for this, and we call it OB3. This is some of the media and on the front end, certainly some of the some parts of Congress refer to it as Big Beautiful Bill. I call it OB3 or the summer tax legislation. In any event, it did return some of the benefit. The R&D credit was always there, but the way you had to treat it for tax purposes from 2022 through 2024 was that you would qualify people's pay, you would qualify maybe your spend with the LunarLabs or similar outfit, you'd qualify all the different categories of spend, and that would be the basis for your claim. And before 2022, those were all fully deductible expenses on your tax return. Beginning in 2022, you had to capitalize and spread them over several years. When it's a money spent domestically that does qualify for credit, you spread it over 5. When it's money spent with a foreign outfit, not only can you not claim that towards a credit claim, but you had to spread that spend over 15 years rather than deducting in one period. A little bit tax technical here, but I think it was the takeaway is that it was kind of did everything that an R&D credit wasn't supposed to do. It de-incentivized companies from investing further in development because they were now going to have additional tax liability that outpaced their savings. So companies really shied away from the credit for a few years. But the legislation that passed in July for 2025 tax years and moving forward, it's fixed that domestic spend where it's now fully deductible again. That's a big deal. If you're a smaller business under 31 million in revenue, you can go back and amend tax returns for the 22 through 24 years to claim your full deductions on the amended return. So that kind of gives you that money back, so to speak. It doesn't change your credit claim if you were making one, but it does give you those deductions back, which can be a windfall for a small business that had to capitalize the spend over the last 3 years. And then for everybody, you can just wait, and when you go to file your 25 return, some of these deductions that were deferred in prior years, you could put them into that tax return. So if you had a really profitable year in 2025 and you've been claiming the R&D credit historically, it might be a chance to go ahead and accelerate all those past year deductions that you thought you were going to have to push out over a number of years, and keep your tax bill low and get the credit on top of it to offset any tax bill that is remaining after the deductions. So good answer here. Go ahead, Elizabeth.
Huge one. Yeah, this is when I was in DC talking about this with people, we were hearing so many different stories from different people in the group. And one of the people said, because I had to do this, I didn't expect to have to do it, and we were not able to hire people. And so our team was working like 80 hours a week because we were expecting to be able to hire to be able to use this, and then because it was being amortized, we just couldn't do it. Another person that we talked to was talking about way back when this happened, and when they went to this amortization schedule, instead of allowing you to take the deduction, she did not expect that, and they got a huge tax bill, like $100,000 huge. And it was shocking. And the company almost had to shut down. They had to take out some loans to be able to cover it. And because they weren't expecting it, because they were depending on this R&D tax deduction so much. So, I mean, it really is huge and makes a huge difference for a lot of businesses. And the businesses that are able to use this effectively now that it's back are going to be businesses that are more innovative and are able to do more things. And it helps your business so tremendously. And just the horror stories that we heard when it went away told me everything I needed to know about why we needed it to come back.
Yeah, no, the problem was that people, it passed as part of the Tax Cuts and Jobs Act in 2017. And then there was this understanding in our community of providers that maybe overly optimistic that they would correct this issue, because it's one of those things that they plug into a big tax bill, as they often do, to get the budget to balance. And there was this perception that there would be a fix, and then the fix didn't come. And so I think to your illustrative example, people got really big tax bills that they were not expecting, because maybe we certainly were trying to communicate proactively, but I think there were providers out there in this space, especially if you're not CPA shop, that's more plugged in with the broader picture of tax, that weren't thinking about the tax part. So they're just a consultant helping you claim an R&D credit claim, but they're not keeping their finger on the pulse and kind of preparing their client for this bad news that's coming. And then it came, and it was a really, really bad news. But fortunately, that's further and further in the rearview mirror, and there are some remedies for smaller businesses and really all businesses to kind of catch up on some of what was lost. Again, this is a domestic fix. I think the IRS wanted, or Congress wanted to leave the foreign piece as it is, because the R&D credit at its core is to incentivize U.S. development. So foreign spend is never qualified. It continues to be required to be spread over 15 years, and that's to encourage small businesses to develop domestically. And I think that's a fair, in most cases, a fair premise. So sometimes it does make sense to on and offshore development, and just be aware that like that foreign offshore development continues to not qualify for credit, and does continue to be subject to this kind of punitive spread of the spend over 15 years. This is a really nice benefit. We've talked about startups a lot today. And I think some people think about the tax credit, and we talked about that earlier, dollar for dollar reduction of tax liability, but a lot of people almost plug in the word income in front of tax. And yes, the federal credit can offset income tax, but if you're a small business and you meet these criteria, Most any payroll provider you're working with can assist you in taking the work that we do and putting it on to the right type of form to make an election, but you can apply the credit claim against payroll tax, and that's huge. So you may be pre-revenue, or you may be making a little bit of revenue but not turning a profit. So you're like, okay, why am I going to do an R&D credit claim when I'm going to create losses for 5 years and have to work through those losses? And so I'm looking 5, 7, 10 years down the road before I can apply the claim. If you're in this small business world, so less than 5 million in gross receipts in the, and that should say election year, so whatever year you're making this election, if you don't have 5 million, more than 5 million revenue, and you haven't been around for or reported revenue for more than 5 years back in time, your credit claim can be elected to be applied against federal payroll tax liabilities. Now, if you have a heavy contract spend, maybe your liabilities aren't as long, but it carries forward. So even if you reduce it a little bit each quarterly payroll report, it's a great way to get more immediate monetization back for a startup that is not in a world otherwise of being profitable, where they're going to have a tax liability from an income tax perspective. And they expanded that a couple of years ago. Used to be 250,000 against Social Security. It's now 250,000 against both Medicare and Social Security. So if you have, say, a $75,000 claim that you thought was 10 years away from realization, it's really could be much more immediate in the way that you're able to monetize it if you're a small business that fits these criteria. I think that's one thing that regularly, when I'm having conversations out in the community of folks, especially in the startup space, they're not aware of this opportunity. I don't know, Elizabeth, if you have anything to add there, if you've had any stories along those lines, but I know you're aware of it, but I don't think everybody is. So I just want to bring that, highlight that. So this is kind of a good summary of what we talked about today. Driven by activity, tying spend, paths to monetization, and then again, it's back to full deductibility in 2025. So this is a credit that can be a deal breaker in a good or bad way. When it didn't go away, but when the tax picture changed, it did spurred a lot of companies to really rethink hiring, or maybe scaling back their teams, because they weren't able to monetize the credit the way that they used to be able to, because of the way, or even if they're monetizing it, their tax bill jumped way up, so the net benefit went down. So it de-incentivized spending. That's been fixed. Again, it's all about the 4-part test of activity, and then tying the different categories of spend. And I would say we touched a few points on tracking contemporaneously. That's important. So tracking time, tracking meetings. The more you can track real time and have it in your file, when we or another provider comes and helps you with this claim process, it doesn't dramatically reduce our workload, but it maximizes your result. So we still have to put in the work. We have to vet activity and vet the projects, but there may be projects that wouldn't be on our radar without good documentation, and all of a sudden come into the fold, or people for that matter, that allow us to cast the net wider for you as a company that's doing innovative things and maximize your credit claim. And we didn't touch on the state level claim today. I can speak. I don't think I have a slide on that, but I do not. But so there's not a state level claim in Alabama, but I know maybe some of the audience is sitting elsewhere in a different part of the country. Hopefully they'll look at a state level claim in Alabama, but many states, I sit in Georgia, in Atlanta, and Georgia has a similar opportunity to take a second bite at the apple, so to make a claim on your Georgia taxes, and they have that election, regardless of whether you're a startup or not, of electing to apply the Georgia credit claim against Georgia payroll taxes. So maybe you're even a more mature business, or you've hit the ground running and you're hurdled that $5 million of revenue, and even though you're in the startup world, if you have some Georgia employees and therefore some Georgia activity, and you're filing in Georgia or another state, I use Georgia as an example. A lot of our clients sit here, being based out of Atlanta. But just the takeaway is about 38 to 40 of the 50 states have some type of state level claim. So just know where you're doing business and where you're filing, and if you're aware your development activity sits, don't miss that second bite at the apple beyond the federal claim. So most of the methodology at the state level aligns with the federal methodology. They might have a different mechanical calculation, but in terms of what is qualifying activity, what is qualifying spend. It's very much aligned with the rules at the federal level. We've got a couple minutes left, Elizabeth. I don't know if you have any kind of closing thoughts or kind of closing the loop here.
Yeah, we'll let everybody drop their final questions in the comments if anybody has any, but I had a question that came up when we were talking about the customizing software versus off-the-shelf solutions. Is there a threshold for customizing the software? So this is maybe a little technical, but if we're using an existing API, like the back end of the software, or even an existing AI model, so you can build a ChatGPT wrapper, but we're building new software on top of it, that's an ultimately a custom solution with all new functionality. How would we know if we would qualify in that scenario?
I would say if that software solution is something you're going out to the market with, like a customer-facing solution, I feel pretty good about that as long as you're documenting that path forward beyond the kind of the foundational API or AI model. Now, in an internal use software world, remember our SAP example, and is it a foundational platform that you're then expanding on? Even though there might be a significant amount of additional development, it's not necessarily a no, but it could be a maybe there because of the IRS's perception on internal use software as needing to be kind of blank canvas development. But it's really in the AI space, I'd love to have more clarity there, but we don't have enough case law yet that's really interpreting the code in a new world. I mean, we have case law that applies to development activities that existed historically, but AI and AI related development is such a new thing that we haven't seen enough cases come across the IRS's desk, the tax court desk, to see how they view it. But I think the safe play again would be if this is customer facing and you're documenting that additional path of development beyond the foundational piece, probably not too high of a hurdle to qualify. But if it's internal use, probably just need to be a little more cautious in how you look at that.
Awesome. Well, we did not have any other questions come over through the chat. So I just want to wrap it up and say thank you so much to Brad for joining us today. We were really, really grateful for your time. If people want to use LunarLab services to qualify for your R&D tax credits, give us a call. You can always reach us at LunarLab. LunarLab.io is our website address. And then Brad, for you, if people want to contact you and ask you about R&D tax credits, how can they reach you?
They can reach me at my email address. I'm very responsive, and I will say, like, the front end discussion we have with any prospective client is a no charge. So it's not going to take up all of your day. It's a 30 to 45-minute conversation. Usually we try to include finance and then a leader of the development effort into that discussion. That's going to be more efficient. Sometimes we'll have a first call with the CFO, but then we don't really have a feel for is the activity qualifying. So it's very helpful for the leader or leaders of the development effort to be on the initial call, probably even more so important than the finance team, so that we can get a high level view. Do we think there's even activity that would fit the 4-part test? Again, we're going to decide how much of it qualifies, but you want to at least have a feel for that from an initial discussion, and that's going to be a no charge. But yeah, my email address. I'm on LinkedIn. I love to connect with people there. I'm always connecting with growing my network there. I think it's a useful tool to kind of digitally network and also stay in touch. But I should include my mobile on here. I'll do that in the future. But just shoot me a note, and we're happy to support you in assessing initial activity and credibility opportunity. And then or even if you've already been taking advantage of the claim and you'd like to get another option as a service provider, then we're happy to give you a proposal there and see if it makes sense to work together.
Awesome. And I know that people have already contacted you from our last session and are already saving money on this. So really, really exciting news. So like I said, if anybody ever has any questions, feel free to reach out to us. We're LunarLab at LunarLab.io. That's our web address. You can always reach us on LinkedIn as well. So grateful to everybody that could join us today. So grateful to Brad for sharing all of his wonderful information with us. And we hope to see you again soon on our next live stream. So have a great day, everybody.
Thank you.